Welcome back. Well, one way we can measure economic growth is through the amount of taxes on a state basis that's collected. And this data is collected on a quarterly basis from the US Census Bureau. And essentially, what happens is as the economy improves, the state tends to collect more taxes. Revenues are up, spending is up, consumption is up. Well, the latest report on a year over year basis, the quarterly report showed an 8% decline. They collected on average 8% less than they did this time last year, which is concerning. And it's the first time we've seen this happen going back to 2021. But it's actually even more significant than that. We can see on a year-over-year basis, a quarterly taxes collected. This is the only the fourth instance in the past, well, over 25 years or so. We see the last time we saw a negative number was April of 2020. We had a couple negative blips in 2013 and 17, but the last significant downturn before that was 2008, 2009, and before that was 2002. So we can see the current quarterly report is actually quite significant. It's only the fourth instance in the past 25 years or so we've seen such a decline. Now we can see here, this is on a year-over-year basis. This is the average. These are the average. This is the average of all 50 states, and this is plotted against the S&P 500 in red. And during those periods of time, we see economic growth and stronger stock markets. We tend to see superior amounts of collection of state taxes. Conversely, 2018, the stock market got, a little bit self in trouble. We only had a 4.2% year-over-year increase. 2020, 3.9%. Now, 21, 22, we saw superior stock market performance and an increased amount of state taxes collected. The current quarterly report shows a negative 3.2% decline, and that certainly is troubling, and it correlates with rather weak stock markets we've seen lately. Now, here it's plotted against the CPI in red, the Consumer Price Index on a year-over-year basis. We notice the latest report was 3.7%. Notice in the past, when we've seen stronger periods of economic growth, we tend to see a greater amount of state taxes collected. Conversely, 2018, 2020, we saw weak stock markets, also a rate of deflation or just lackluster inflation, and we saw a lower amount of state taxes collected. Of course, last year we saw a tremendous amount of inflation and also a tremendous amount of state taxes collected. But again, the latest report is quite troubling. It's negative, and it certainly coincides with a decrease in the amount of inflation. This also coincides, has a negative correlation with the federal funds rate in here in red. And we can see during a period of low interest rates like 2015, we saw a lot of state taxes collected. Conversely, when interest rates rise, we tend to see 2018, 2019, the state was able to collect less taxes simply because higher interest rates make consumption, make growth and borrowing that much more difficult. And therefore, there's just less tax revenue to be collected. Now, currently we have extremely high interest rates, relatively speaking, over the past couple of years. And again, a negative quarter is most recent results. Just goes to show you that higher interest rates, now it's used to slow down the economy. But, one facet of the economy is the amount of taxes that are collected. And we certainly see, a relationship between the two. Now, here we see state by state, this is on a year-over-year basis. The quarterly report shows us only 5 states or 4 states were able to record positive taxes. Those states include Louisiana, Mississippi, New Hampshire, and Wyoming. In fact, the vast majority of the states actually showed a decline on a year-over-year basis. They collected less taxes this year, than this time last year. Also, taking a look, these are the top 10 states that represent the greatest amount of net taxes collected. Number one, California, New York, Texas, New Jersey, Illinois, Florida, Pennsylvania, Virginia, and North Carolina. These figures are in millions. Now, if you take a look at the top 10 states, the vast majority of these top 10 states noted a decline. California collected 34% less state taxes than it did this time last year. New York State down 18%. Texas is up 3, New Jersey down 8, Illinois down 7, Florida about flat, Pennsylvania down 6, Virginia down 8, and North Carolina down 6, which is troubling because of course you have smaller states, but these top 10 states represent the vast majority of the taxes collected, and almost all of these top 10 states marked a significant decline. Now we see here the top 10 states are represented with the blue histogram bars. The red line is the S&P 500. And if you only take a look at the top 10 states, you'll see a pretty strong correlation. When we see stocks tend to rise, we also tend to see the revenue collected also tend to rise. This year, we've marked a little bit of an increase. This is on a dollar basis, a little bit of an increase versus the prior year. But the fact of the matter is, the stock market's weak, and we can see that the top 10 states collected, on average, less than they did last year. Now, here we see the quarterly average state tax revenue collected on a year-over-year basis. Again, we're down 8% on this quarter's reports. It's the first decline in quite a long time, and it is troubling because it does show that there's just less capital, less taxes to be collected as economic growth continues to slow. And comparing to the S&P 500, again, it's really no surprise that stocks are weak in an environment where there's just less economic growth, and it's affecting not only jobs and inflation numbers and industrial production and things of that nature, but it's also making its way to the state level as far as the tax revenue is concerned. And we're going to keep a close eye on this. It's a quarterly report, but we do have several other incremental reports that reflect to this and speak to this number as well. We hope this has been helpful. We look forward to seeing you back soon.